What is up, my beautiful people? Good morning. It doesn't look like morning. It's rainy all of a sudden. It's really gloomy, and I wake up. I just sound tired when it's rainy. So it's raining outside. It's gloomy. The market's kind of bounced a little bit with futures slightly. There's been a reiteration from China. There's a lot of stuff going on. But before I get into that, I guess let me tell you that we are going to stream today. I'm thinking at around 10 or 11. Probably closer to 10:30, 11. We're going to do a stream. I'm going to be live. We're going to review plays, go over some of the big plays I hit, why I was up $3,000 or $4,000 on close, what plays we made, go over it. I'm going to bring one of my buddies on. He wants to learn how to trade options, so I'm going to go over some basic stuff with him. So make sure you guys are actually there. And I'm going to try to move this camera around less. I know some of you are getting bothered by how it moves. And I have another video I'm dropping. I said the same thing in it, but I had my analytics up on the YouTube over here. I love you guys. Thank you so much for subscribing. This has been really awesome so far. The channel is growing now. I'm seeing a lot of feedback from people. I really, really enjoy it. I hope you guys are enjoying it. I'm seeing you are, so subscribe if you're new. We post like 5 videos a day, so turn on post notifications. If you get annoyed easily, then yeah, sorry, it might not be for you. But yeah, I love you guys. So let's talk about the yield curve. And I want to talk again about this because I was actually, I don't want to get deep on it, but I had a thought yesterday. I was like, man, I can't believe the yield curve inverted yesterday. And this is what it is. Go watch my video yesterday on why the stock market crashed 800 points to get a better idea, because we talked about this. I brought it up. But again, the thing with the yield curve is that it's predicted since 1980. I said that. Somebody commented it's predicted every recession. And it is big. When the yield curve flattens or inverts, the predictive power of the yield curve on recessions is amazing, but it's also very mysterious. So that's also my issue right now too. I have my theory with it. I think I've learned how to play, and I want to talk about it with you guys. Not all of it. I want to share with you guys how, what this means. Like, do you buy puts now? Do you short the market? Because it seems like the big reaction on yesterday, Tuesday, it prompted a lot of people like, oh my gosh, yield curve this now. And then I know a lot of people, if you guys are new to this and haven't been exposed to it, you're going to think the yield curve is just like, okay, boom, this is what happened. So we're going to go over this chart and see, but that's just not really how it works. So I want to make sure you guys are there. And I want to put this out to help you guys. Honestly, this is information. Again, I'm going to space it out in videos and timing to make it more digestible and make it beneficial for you guys, because I don't want you guys to be trying to use something irresponsibly. But I figured, this is that time, the market is actually turning. We are seeing stuff like that, and my job is to at least inform people. This is the stuff I wish, going after, if I knew how to read the yield curve, if I knew what I knew about global economics back when I was 15, 14, when I started to trade, my family wouldn't have lost everything. We lost over 30, 45 houses in San Diego, went from rich to about to lose our house. So, went from poor to rich to poor. And this is interesting stuff. If you know how to use it, one, you could profit a lot on the put side, but you could also make a lot of money on the upside, and really safety. This is the epitome of what everybody wants for investments, and having the ability to know this stuff will help. So the yield curve is very important. So again, let's start here. Understanding, as a quick recap, why it's bad when the yield curve inverts and what happened. Our 5-year is now a lower rate than the 2-year, and it's about to happen on our 10-year pretty much. Think about this in terms of credit. Somebody with a good credit score, a good borrower, they're going to have a lower credit yield, meaning they're lower risk. So the lower the yield, the lower the risk. The higher the yield, the higher the risk. So what's essentially happening on global bonds, investors, and these are, go watch my video on bonds. I'm saying, go watch this video, go watch this video. But again, we have a lot of stuff I've covered. The bonds, how they move and why they move is for certain investors and big investors, and that's treasuries and governments. But essentially, your short-term yield is rising above your long-term yield. A higher yield means more risk. So think about what that means when it's saying there's more risk in 2 years than there is 5 years. There's more risk in 2 years than there is 10 years. What could be happening, and what situation is boiling? And that's something to take note of, because now if you think 2 years or 5 years is going to be worse than 10 or 15, that makes sense in an economic cycle. That's exactly what happened in '07, and we're going to go to the yield curve. Let me show you guys now, and it'll make sense. You know, '07, the curve is flattened. The curve is flattened or inverted. '06, '07, this is pretty much where we get it. You can kind of see there, your 2-year is the same as your 10-year or higher. So it's pretty much saying you're expecting another cycle to go through, because in a new economic cycle, the first couple years are going to be bad, like this one is saying, but 10, 15 years later, it will be recovered, which is why that yield is lower than the short term. So it's interesting, but let's go through this. Again, I want to give you guys more and more understanding of it and seeing why this is bad, and just the fact that it's through the bond market. Bonds don't move easily. Bonds take a lot of money. Bonds move in conjunction with the stock market. And quite frankly, for you traders, option traders, day traders, you guys ignore the fuck out of bonds. It's just, especially millennials, you don't give a shit. It's just boring. And I get it, but these are those big moves you want to understand, and understanding this effect. And now, like I'm saying, people are worried now that this happened, as well as computer programs. But then also, people are already writing this off, and this happens every year. There's always people who come out and say the yield curve is wrong. It doesn't matter. Nothing's happening. They don't really give a shit. And sometimes it could be true, but why? Because it's so hard to predict and use. So let's take a look. I'm going to animate this from the beginning. Let's start here. You guys see the stock market. This is 2001, and then this is the yield curve. So we're going through the dates. This is March 1999. You see the yield curve is normal, and let's discuss here too. This is a normal yield curve. Even if it's all fucked up here, and even like your 10 years lower than your 7-year here, that's a problem. That's one inversion, just like we're experiencing now. And again, look at where the stock market is. But as long as your short-term rates are gradually increasing than the long-term rates, and you could go like, bottom to top, that's a normalized curve. So keep watching and see what happens though. The curve goes still normal, and then finally you see short-term rates rise. And that's something I will tell you. This is another fun fact. You guys see the 3-month. A lot of people see the 3-month. It'll make more sense when we get into 2008, but that is controlled by the Federal Reserve. So now you see the curve is inverted. The curve is inverted. Now this is an inverted curve. This isn't a flat curve. It's inverted, where literally short-term rates are higher than the long-term all the way down. This is a perfectly correlated negative slope. And look where the market's at. So then it's inverted. Oh, I snapshotted it there. So that's where it was at the top. Then you see what happens, and then boom, it comes back to normal, and look where the market is. The yield curve changes, and that's what I'm saying. These are bond moves and activity, but now the market's pretty much, since it inverted, the market has been down now a big portion. And then as we see what's going to happen, it keeps going. Look at the yield curve. So that's one thing to take note of, and now keep watching it from 2001 into 2007. Because now the curve normalizes, and this is what I was talking about with the Federal Reserve. You see it in 2001, you'll see it in '07, but notice the 3-month is dropping so much. If we go back here, what made it drop so much? The 3-month is the Federal Reserve. That's controlled by the Federal Reserve. So that is the 3-month is the short-term lending rate. They control that. So when you see that dropping, that's the Fed cutting rates like they do during most every economic crisis. So again, you see it coming down. Rates now drop from where they were, which is insane. You could see it here. And the stock market's bottoming. The curve is fully normal, and then it starts to rip. So now we're at 2003 June. Again, still going. You see the S&P ripping up now, and the yield curve staying there. And that kind of looked like our yield curve recently for the last few years, but take note. So 04, and you see the rates are going back up. That is the government raising rates. Again, the 3-month is controlled by the government, the Federal Reserve. So now 2005, 2006, we're flattening out. Kind of looks like how we are today. It's still normal. And then boom, come here. May, it started, but May pretty much, your curve flats, right? It kind of looks, it's not as inverted as 2001, but it flattens. But now, you saw it invert last time here, and it dropped. This is where the stock market was, but now it's flattened here, and you know, your curve is still flat. This is even saying it's inverted, but you know, it's clearly dropped, but the market isn't at a low. So if you shorted it from here, you would have just got crushed for 6 months, maybe, or May till October, or next May, a year. You probably wouldn't have gotten yearly puts. You would have got smashed, and then it came back down. And then you see the yield curve and as well and what's going on. It goes back into normal, crash mode happens, and we see what's going on. And again, look at the yield. This is because 08, they just start cutting the rates all the way down to 0 because the world was going to end. So now the world was going to end. Boom, they kept it at 0, and then boom, you see over the years as we get back into 2012, 2013, 14. Notice it looks like someone's just stepping on the 3-month. That's because that's what the Federal Reserve is doing. They didn't start raising until 15, 16, and now you can see these last 2 years where we're at and what's going on. You guys see, so now our short-term rates are rising. It's just playing out like every other crash did, but now it's coming down to the timing. So you see, we're really getting flat here. Now we're flat. It's getting there. See? Oh, it's getting there. It's gonna reset. Yeah. So we're almost there. You know, in little parts of the yield curve have flattened already. That has been the important decision so far. But now the big issue is what is gonna happen. What kind of crash? Is it going to be like 2001 where the yield curve inverts or flattens and drops right away? Is it going to be like 2007 where it happens a year later? And then I wish we don't even have the data from the 80s, but it was similar to that. That's why people now are so confused about how to use this yield curve, because you can't predict it. You can and you can't, if that makes sense. They know, but now 6 months to 24 months is a huge time window, especially trying to make money, timing the market, getting puts, saving your portfolio, all sorts of stuff. So I'm going to leave it there. We're going to stop there. Let me know your guys' take, how you think this is going to work, and make sure you subscribe so when we go over, I'm going to explain in the next video how this works and literally how you are going to be able to predict a recession 100% of the time. And that sounds crazy, I know. But I have my theory, so it's not like I'm giving you a guarantee. I'm just going to share my theory with you. So I'll leave it there. I love you guys. I hope you enjoyed it. Yeah, stay in school. Stay good. Love you. Bye.